But I think the reason for the pivot is going to be a massive amount of deflation in the system. It's already here. If you look at commodity prices, the gold price, for example, it actually peaked in August of 2020, and it's at the lower end of a 2-year range, while copper has broken down, oil is breaking down, lumber has crashed, iron ore as well. Freight rates out there are suggesting that the supply chains are loosening up quite significantly. The rates are coming down. So we've got deflation in the system. And the way I describe what's going on right now, I was in my early days in my career in the early 80s when Volcker was taking a sledgehammer to inflation because it was embedded in the system after 15 years of profligate spending, Vietnam War, Great Society, and then going off the gold exchange standard. A sledgehammer, that's what he needed. That is what I believe Chairman Powell thinks he needs. And we just don't think that's true because we see so much deflation. And then one more thing, we also see a massive inventory overhang around the world. You've got Europe in recession, China in recession effectively. And here in the United States, retailers are bulging with inventories, which will have to be cleared with discounts. So we think we're going to see some major downside surprises in inflation during the next 3 to 6 months.
Yeah, so many important points there. I want to get your take on what this means for the macro story. First off, on inflation, will the Fed be able to reach that target of 2%? And when do you expect the Fed to see inflation at these targets?
So the Fed is looking at the PCE deflator, which peaked in February at 5.3%. It's down to 4.6%. And we believe we've already seen some negative numbers. Nobody believes them. We do. And we believe we're going to see some more negative numbers during the next 3 to 6 months. So wouldn't be surprised to see it well down into the threes in the next 3 to 6 months, if not into that 2 handle. And I think if we get enough sequential declines, that the Fed will change its tune quite dramatically.
Wow, that is a big deal. You're talking about 2% inflation within 3 to 6 months over in the coming year?
Well, I think that the Fed will be looking at the sequential numbers, many of which will be negative. And that will encourage them. Even if we don't have that 2 handle, we're in the 3s and we're coming down quickly, I think they'll change their tune and perhaps they will take interest rates up 75 basis points this time, but the next time 25 to 50 basis points, and then following that, we shall see.
And this expectation that we would see a pivot, that the Fed would blink, essentially sparked that pretty good rally in the month of July. But what is it going to mean for the macro story, Cathie, and your view on profits? Because we've got the second read of the second quarter GDP coming, showing a contraction of 0.6%. This after a 1.6% contraction in the first quarter. Tell me what you're expecting in terms of the profit impact here and the impact of the Fed slamming on the brakes, pivoting here, and impacting the macro story.
Sure. Well, we think profits are going to be under tremendous pressure. And until some of these cost declines make it through and inventories are cleared. Now, we do not think this will be anything like 08-09, which I know many people fear. We think it's much more of an inventory recession and a drag from the rest of the world, Europe being crushed by energy prices, China being or readjusting to quote unquote common prosperity. So I think it'll be more of an inventory recession. And, there's been a lot of denial that we are in recession. We think we are. We think it's an inventory recession and that we'll be coming out next year, whereas many people, forecasters are saying we'll be going in next year. So I actually think the market will be looking up as we're exiting this year.
Do you worry that Larry Summers will ultimately be right? The other day, he said, look, all of this focus on slamming on the brakes is going to mean unemployment at 6.5% at some point.
We do think there's been some labor hoarding in here. The employment numbers have looked strong. If you peel the onion a bit, the underbelly of employment is not strong. with household employment essentially flat over the last 4 to 5 months, which includes a lot of small businesses. That's where we see a lot of the pain right now. But the labor hoarding is because companies couldn't get labor during the supply shock and the COVID. And so now that they can, they're holding on a little longer than I think they would normally. I'd be surprised if we go all the way to 6%. I do think the inventory recession will be somewhat sharp and will take the unemployment rate up, but I'd be surprised to see us get all the way to 6%.
Cathie, your work and your incredible research has led you to create thematic exchange-traded funds. You are invested in everything from DNA sequencing to internet to AI. I want to get into how you're allocating capital right now, how you have made money in this space over the years.
We see the growth coming out of these 5 platforms. These are 5 innovation platforms. These are exponential growth trajectories. And we faced a lot of COVID-related comparison issues in stocks like Roku, Teladoc, Zoom, and so forth. So there's been a lot of confusion on very short-term indicators in the market. But the explosive growth is there. It has happened, and we think it's going to continue. We see that in the global public equity markets, truly disruptive innovation, which is all we focus on, is priced at roughly $8 trillion in value in the markets today. That number, we believe, is going to more than 200 trillion during the next 8 to 10 years. So it's going from less than 10% of the global public equity market to what we believe will be 60%. And the reason we believe that it will move to that level is because these platforms are going to disrupt the traditional world order in a way like we have never seen before. We were not around in the early 1900s when telephone, electricity, and the automobile disrupted the existing world order. These are 5 platforms, not 3, and they involve 14 different technologies. So we do extensive research. I think we do the best research, if I might say, because of our sole focus on it. And we give that research away because we want people to understand how their lives are going to change and how their children's, grandchildren's lives are going to change, and how important it is for all of us to get on the right side of change.
Yeah, and I understand that long-term look about how revolutionary all of this is, but Cathie, how long can you stay on this theme when markets go against you? You had an incredible run for so long up until this most recent upset in the market. Now your ARK Innovation ETF in a bit of a slump, down nearly 60% this year. Tell me what you do in terms of hedging, if you can. For example, you've got a market that is very nervous about how slow things get, and that's why for the first time in 15 years, we're seeing value outpace growth.
Yes, well, we think if we're right about what's going on in the economy right now, and inflation is going to come down fairly dramatically, that will be a big positive for growth stocks. The compression in our performance, what we do during periods like this is we concentrate our holdings towards our highest conviction names. So we have taken our flagship strategy from 55 names down to 33 names. We did the same thing during COVID, but that was just a 1 month worth of pain, and it was awfully painful over a month. And from the lows in COVID, we moved up in the span of less than a year by 360%. So that was probably ahead of its time. We've corrected tremendously. And now we have many what I would consider deep value stocks if you give us a 5-year investment time horizon. In terms of hedging, what I just described, that concentration strategy, people would say, oh, well, my goodness, you're taking more risk. No, we're not. We have a scoring system, and which naturally takes us towards higher scoring names during corrections. So it's kind of a pruning of the portfolio. And in terms of hedging, that's not what we do. That's what asset allocators do. That's what advisors do. we are a slice of their portfolios, and they will position, depending on clients' risk tolerance, they will position us anywhere from 2% of their portfolios towards 10%. And as I said, I think in the broad-based benchmarks, our strategies, our stocks, will end up at more than 60%. So we are in very early days, and that's why we encourage our investors as well to get on the right side of change. It's been awfully painful, and believe me, I do feel it, and we're completely committed. We actually increased our own ownership of our firm in the middle of all of this. That's how high our conviction is, and almost every employee participated in that.